Hi, this is Ashish Shanker and I'm happy to present to you the key highlights of the latest version of our monthly publication Alpha Strategist. Last month, globally we saw a lot of central banks trying to revive growth again. We are back into the quantitative easing mode globally as trade tensions as well as certain other variables have slowed down global growth. And we are looking at lower interest rates again. Fed followed by the ECB, all of them pledged to keep interest rates low for a prolonged period of time, and they've also pledged to buy back bonds again from the market. As far as the domestic situation is concerned, we are also witnessing a slowdown. The last GDP growth number was 5%, and as per our economists' predictions and looking at the high frequency indicators, it looks like we are headed for another quarter of probably sub 5% GDP growth. We are in the midst of the earnings season, and more than half of the companies have reported their results. What we are seeing is weak commentary on growth. Top line growth commentaries have been pretty weak from consumer companies as well as from investment companies. However, we've seen some optimism and some cheer in the festive season as retail sales have picked up. However, it will take time for wholesale sales to pick up as there was a lot of inventory in most of the channels. But the good thing is that the government is cognizant of the slowdown, and there are several measures that they have taken to improve growth, including putting out a lifeline for real estate firms by giving out a fund up to 25,000 crores for last mile real estate funding for projects which are stuck. They've announced several measures to give more liquidity to the ailing NBFC sector. RBI has also reduced interest rates quite sharply. However, the issue is of transmission, which we believe will take time. As far as fixed income is concerned, due to this slowdown, we are seeing working capital cycles getting elongated, and a lot of companies finding it difficult to meet payment schedules. So we believe that in the credit space, it's getting a little more tricky, and hence we believe that people should stick to very, very high quality fixed income funds, typically AAA, PSU, banking kind of funds is what we're recommending at this point in time. It's not a bad idea to keep some money in liquid assets like arbitrage and ultra short-term funds. We've often seen that long-term investing is not about trying to predict economic growth trends or trying to predict which way certain sectors or industries are going. As there will be several storms, whether it's global as well as domestic. Long-term investing is about building a very sturdy portfolio across asset classes so that anytime you get these kind of situations, you're able to weather the storm well. And asset allocation is the best way to do that. So if you have a nice portfolio allocated across asset classes, equities, fixed income, gold, liquid, we've seen more often than not these portfolios weather these kind of situations much better than portfolios which are skewed towards any one asset class. Valuations across the larger set of companies is very reasonable. There are few companies which are trading at rich valuations, and maybe rightly so, because these are companies which have continued to see decent growth, and corporate governance as well as quality of their businesses is very, very sound. So these businesses are commanding rich valuations. But as soon as you look beyond the top 50 or 100 companies, you see that valuations are very, very reasonable. Hence, anybody building an equity portfolio today, we recommend multi-cap funds is the way to go, because you let the fund manager decide which part of the market he wants to be in. And any multi-cap portfolio today, the valuations are pretty reasonable, because you are investing at a point in time where arguably you are close to the bottom of the cycle. Commentary is pretty weak and pessimistic, and normally when one invests during these times, the outcomes over 3 to 5 years are normally very, very good. So we urge all investors who are waiting on the sidelines or looking to build their equity portfolios to complete their equity portfolios as of now. I mean, earlier we had given the message to stagger it because we were yet not clear as to how things will pan out. We are yet not clear as to how growth will revive and how soon it will revive. But at least I can tell you, looking at the broad set of valuations, they are reasonable. Growth looks like it will revive over the next 6 to 12 months. So these are good times to build an equity portfolio. Again, fixed income, be very, very conservative. It's not a bad idea to have some allocation in gold at this point in time in your portfolio. And we have a product called Me Gold, which allows you to directly participate in gold. I mean, 5 to 10%, depending on the kind of temperament you have and whatever you have listed out in the investment charter. Hence, we believe that this is a waiting game right now. People should not take any hasty decisions. They should stick to their asset allocation mandate. As Warren Buffett puts it, investing is 10% intelligence and 90% temperament. So these are times which test your temperament, and hence you need to wait these periods out. There could be slightly longer, prolonged periods where your portfolio returns may not look that great, but these are times where you need to stick to your basics, and I'm sure you'll be rewarded over a period of time. Thank you very much for listening patiently.